Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
We've got a global market sell-off underway. We've got that because a global tariff war is certainly underway, or feels that way. We'll have to see how it plays out over the next week. For the United States, in terms of tariffs, it takes us back to rates of nearly 100 years ago. Talking with those from the C-suite is super, super crucial for us. And someone who has a front row seat to tariff news is Rob Rich. He is CEO of the Optical Foundry. They're based in Minneapolis. They sell eyeglasses to opticians in the U.S., Canada, and elsewhere. He joins us from Minneapolis. Also with us is our own Nina Trentmann. She's senior editor at Bloomberg News, the author of the CFO Briefing newsletter, which you can sign up for at Bloomberg CFO Briefing, Bloomberg.com/CFO Briefing. And Rob, by the way, is in this week's Bloomberg CFO Briefing newsletter that comes out on Sunday. Nina's why we are talking to Rob. Rob, we're so glad to have you here with us. We know you sell eyeglasses, but kind of lay out your business so that the Bloomberg listener and the Bloomberg viewer understand what you guys are all about.
Well, first, thanks for having me. And glad to be here. So our business is relatively simple. I mean, we design our eyewear and we source it overseas, and then we bring it to one of our warehouses, and we sell it then directly to the provider, being an optometrist, an ophthalmologist, an optician. So we don't sell to the end consumer. So we are in that middle area. And that's really just that's the nuts and bolts of what we do. This tariff has been an issue. We previously we did a little bit of our business with China, and the 301 tariff we absorbed pretty much across the board. But with the new stuff, we don't have the ability to absorb it. So we're just formulating exactly how big the price increases that we're going to implement are and when we're going to do that.
Yeah, maybe that's a good opportunity for me to jump in. Rob, thanks again for joining us here on the radio program. Talk to us a little bit. You said China is in your supply chain. I think Japan also is an important component. So how do you feel about those Japan tariffs that were implemented this week or announced this week?
When we were talking the other day or yesterday, I guess, was when those were literally in the middle of our conversation, when the Japan tariffs were announced. And I said to you, that's just a shot to my heart, because that's where almost all of our production comes from for our products. And, I was hoping that there might be some exemptions for medical devices, because that's one of the exemptions that has helped us in the past. It helped us with the Canadian retaliation from the last round was medical devices were exempt. So we did not have that issue with our Canadian business. But now with the 25% that we've put in, I think the retaliation is going to be greater. So we've got it kind of coming and going, really. Bringing it in, our main source has been hit yesterday, which we have to figure out, again, what we're going to do. And then on the outbound, we're going to be hit because we do sell outside of the U.S. So, and when I say hit on that side, our buyers, meaning Canadian in this case, opticians, are going to be hit with a bill larger, and it's going to certainly slow down our demand. And the other thing regarding Canada, which is really, even though we weren't being hit at this point prior to yesterday, what it's done is it raised a significant amount of Canadian nationalism and anti-U.S. feelings when it comes to buying American products. And we were absolutely feeling that in the last month with our business in Canada dropping 30 to 40%.
Wow. So kind of like a triple whammy to your business just in the last few weeks. Rob, I imagine if a member of the Trump administration's economic team were sitting right here, they would say, in response to you, this is exactly what it is designed to do. Instead of you contracting with firms in other countries. We want you to contract with firms here in the United States and build those eyeglasses here in the US. Are you going to do that?
No.
Why not?
It's even because the cost to make that happen, first, it's cost and timing, quite frankly. You've got a reasonably healthy investment. You can go automated to a degree, but that doesn't help the job market that they're looking to increase. There's a lot of labor involved in making quality eyeglass, even if you have a lot of automation. And quite frankly, people are not going to pay, I'll say, wages that would have to be paid in the U.S. To get that same exact product that even with Japanese, the way the Japanese do it, I can't speak to exactly how they're doing it, but I can tell you that we as a labor force right now are not competitive. And that is the biggest barrier I see. We can get machinery, we can make that investment, but
Rob,
the other side of the coin.
I want to ask you about rising costs, but first I want to ask you, is this possibly going to lead to you either letting go of workers or not hiring workers?
Well, we've already gone the route of made some decisions. We've had a couple of key people, and I say key meaning some of our people have made some decisions to exit, and we have not replaced them by design at this point because we just took the opportunity. It's not that there was anything. We can operate for some period of time right now without replacing those positions, and possibly even maneuver so we don't have to. But yeah, we're thinking of ways to conserve right now because honestly, I don't know what even tomorrow is going to bring, let alone there's no stability. It keeps changing every day.
Yeah.
Rob, how about those price increases? You said that would be one of the tools you have to take because you can't really offset those tariffs that are being implemented. When do you think you'll start to raise prices, and by what degree? Do you think it's going to be per product, per country, or do you already know what that might look like?
Well, I don't have an exact answer in terms of the magnitude. We're working on that right now. It's really the timing that I'm contemplating. Quite frankly, as I just said, everything changes on a daily basis with this administration. And, a lot of bluster and a lot of bullying, and who knows what the response is going to be and how quickly it'll be. I think maybe I don't necessarily implement the price increases next week. But if this does continue on, I would imagine by next month we'll fully reprice. The stuff we have in house right now will carry us for that month that has not been hit, and then our inventory starts to thin, and we need to replace. We already have a lot of our production cycle is long between creating and getting. It's usually about a year process, really, before an idea becomes a finished product. So,
Rob, I'm sorry for jumping in. We only have a couple minutes left. We have a few more questions on the price increases. On who absorbs them? How much do you think you'll have to raise the prices for the frames that you sell to opticians and optometrists versus how much of that cost you're going to have to eat?
Well, as I said before, the Chinese stuff that was done with 301, we ate. We didn't pass that. We don't have the margin to eat it with our cost structure on this Japanese tariff. So literally, whatever it's going to cost us, we are going to pass that through 100%.
Okay.
So a pair of glasses that cost, I don't know, $200. Let's make it simple. How much more might they be then for a consumer? Obviously, it's going to go to the optician or ophthalmologist. So glasses that are $200, I guess, that you sell to them, I don't know, give me an idea of how much they would go up.
My guess is that $200 pair of glasses will probably rise to at least $250.
Wow.
Yeah, that's significant. Yeah. Hey, one thing I want to ask you, and real quickly, if President Trump makes a 180 on the tariffs, I don't know, in a week, in a month, 2 months, I don't know what it might be. Will your longer term strategy, though, still change because of it? Because maybe you look at the U.S. and how it views its trading partners differently longer term?
Well, I mean, listen, my hope is that what will happen will be similar to what happened when he was in the first time in 2016. I have a lot of relationships, in Europe and in Asia, and they were looking at me with, very funny, and they said, look, just let's wait this out. And quite frankly, everything sort of calmed down after he left the first time. I'm hopeful that this is another, 4-year learning experience for us as a country, and then we get back to some level of, I'll say, normalcy. If this is the new normal, I don't know what those changes will be, but they probably will have to be some changes.
And do you, just thinking about changes, you've mentioned pricing to us, do you also consider other changes to your business at this point? Like, I know one of your stores is called LAI stores, so could you consider rebranding? Could you do something else in order for people to not realize that you're a U.S. company?
And Rob, just got about 50 seconds left.
Okay. No, I don't see that. LA Works is an iconic brand in the optical business. It's been around for 46 years. It is, really a jewel, and there'd be no way that I would rebrand that name under any circumstances, quite frankly. So, no, I have not thought through that question beyond really the next month right now. Just trying to make sure we are profitable going forward.
Not easy though, right?
No, absolutely not.
All right.
Absolutely not.
Rob, thank you so much. And hopefully we can reach out to you maybe at a different macro environment as well. Rob Rich, he's CEO of the Optical Foundry, joining us there. And our thanks to Nina Trentmann, senior editor at Bloomberg News, the author of the CFO Briefing newsletter. You can find it at bloomberg.com/CFO Briefing.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
Investors likely focusing on some of the tariffs imposed on countries overseas, possibly Vietnam, which has a new 46% tariff on that. It could mean higher costs for a company like Wayfair, a specialty retailer. It calls itself the destination for all things home. You know it well. Popular for its furniture and home decorating items and serving customers around the globe. With some thoughts on tariffs and the macro environment, great to have with us the Chief Financial Officer of Wayfair, Kate Gulliver. She joins us from Boston. Kate, a bit of a crazy day, and I feel like everybody we've talked to has said the same thing. Tell us about tariffs and how it will impact your business.
Yeah, so thank you for having me on, and happy to be here. Obviously, a highly disruptive day in the market. We're clearly seeing investors react strongly to stocks that they think have a high, international supply chain exposure. I do think this is where Wayfair is different. We operate ultimately a marketplace model. And so this means that we work with 20,000 suppliers across the US and around the globe. And we have an ability to pivot across these suppliers, as demand and needs change. And our opportunity here is that we can show the customer what the best product is for them based on price, quality, et cetera. And that can really dynamically move, as potentially wholesales change and as tariffs change.
So can I just ask you then, Kate, so since you have a global supply chain, different markets, does that mean some of the markets that you operate in or you get your goods from, that they did not have tariffs imposed on them?
Well, we've seen virtually, every country ex-US have some level of tariffs. We work, though, with domestic suppliers as well.
Okay.
So we have a strong domestic supplier base. And then we work with suppliers, across the globe. And I think what's a little bit different, though, versus somebody who has, say, a product that is built to spec in a specific geography, right? Where they have designed the product, they have a manufacturer that they work with in that geography, they have a contract for how much they're going to procure, is we're not buying the inventory and we don't have products built to spec. We also sell a lot of very similar, highly substitutable products. So, for example, if you're looking for a bar stool, we may have bar stools from several different geographies. And our suppliers are going to be focused on how do they get that top slot in, the sort of homepage as you get into it, so that they get the most conversion on that product. And part of that comes down to price. And so we create a naturally competitive dynamic through the marketplace, and we're able to sort of lean into where prices are most efficient or lean out of maybe where they're less efficient.
Kate, products that are bought on Wayfair right now, what percentage of them come from inside of the U.S. versus outside of the U.S.?
Yeah, we actually haven't given a breakdown by geography because of it's so dynamic, right? So it moves around quite a bit based on where you are in the sort order. So what happens is as the wholesales change, our take rate stays the same. As the wholesales change, your product may move up or down because it's perceived as more or less, attractive to the consumer. And within that, then you might see changes in what supplier is getting more volume and then therefore what geography is getting more volume. So it moves around quite a bit.
Kate, hang on for a second. Just a headline crossing the Bloomberg terminal. This is coming from the president making some comments saying Elon Musk may depart in a few months. Also saying, let me just check, he can stay as long as he wants. The president continuing on and saying that Elon Musk can stay as long as he wants, but again, saying that he may depart in a few months. The president also saying he likes interest rates going down. And we certainly have seen all along the U.S. Treasury curve, the rate market move down. So that has certainly happened, but that is fears over growth slowing down in the United States. Let's continue with Kate Gulliver.
Hey, Kate, on not on Elon Musk. I'm not going to ask you to comment on that. I want to go back to where your products are made. You can if you feel free. I'm wondering about comments that the president has made in the past. I believe, and I don't have the comments in front of me, but he said something along the lines of, what happened to the American furniture industry? We used to make so much great furniture, and I believe he called out North Carolina as a state where we made furniture. Is it realistic in your business to buy more products that are made in the U.S.? Is it possible we see a return to manufacturing furniture in the U.S.? I mean, high-end furniture still is, but let's be real. Not a lot of the furniture that Americans buy is made in the U.S.
Yeah, so we operate obviously a mass market brand, right? Wayfair sells, for the average American consumer. We do have a high-end brand called Paragold. Their sourcing can, be a little bit different than Wayfair as a whole. What we're focused on is being able to source and show the best product. So if that product is more competitive in the US, then we can show that product to our customer. If that product is more competitive in a different geography, then we actually have the capability to get that product to the country, delivered efficiently to the customer. You've seen, obviously huge improvements in logistics. We have a US, logistics infrastructure that allows us to do that. So, certainly if you saw US manufacturing return, we would be able to continue to work with, US suppliers there and potentially continue to expand there. But we want to focus on what delivers the best value for our consumer. That is our, maniacal focus. And it's what has allowed us to take share over the last several years. It's been a very disruptive period for the category as a whole. And we've continued to be a share gainer. And we do that by continually offering the customer the best value proposition.
So on that, because you have thought about the customer and putting them first so often, and I am curious, Kate, will you guys have to raise prices at all? Will any of this that's happening in terms of tariffs, will you have to pass higher costs along to your customer?
Yeah, it's a great question. So the way that our pricing model works is because we're not taking the inventory, the supplier of that product sets the wholesales, and then we apply a take rate on top of that, right? And so if wholesales go up, and the take rate stays the same, you may see differences in prices. That's where it's really our responsibility to work with that supplier and help them understand the demand impact of that. Because we sell, as I said, many bar stools that might look similar, if one supplier raises price and one supplier keeps price competitive, right, keeps wholesale competitive, they will get more demand. More demand will accrue to that supplier, which may be better for that supplier overall. So it's really important that our team work very closely with the suppliers to help them see this data, be very transparent, help them understand other ways they can grow volume with us. We recently launched our Wayfair Verified program that's designed to make the shopping experience easier for the consumer. It points out to her products that we have vetted, that we know to be high quality, and really meet the bar. That's a great way for you to consolidate demand in a category if you're a supplier during a period like this of disruption. And so we think that there will be suppliers that, win out in the marketplace in this model.
How are you dealing with these new tariffs? Like, what are the conversations you're having with suppliers? What are the changes you're making to your business?
Yeah, we're really trying to help the suppliers understand, here's how this might, impact your demand, right? So here's how to think about what wholesale price increases could result in retail prices. Here's how to think about other ways that you could stimulate demand in this environment. And here's how you're positioned relative to other folks, that are selling similar products. We're quite transparent about that data. We've operated the business for over 20 years. It's a tech-enabled business, and many of these suppliers we've worked with for quite a long time. So we have very deep relationships with them, and this is a moment where that advantages us because we're actually able to call them up, get on the phone with them, and help them think this through, and help them think what tools they want to use. Right? Are you going to use price? Are you going to use promotions? Are you going to use, verified? Are you going to use, our supply chain, our U.S. logistics network to help consolidate demand? But how can you make sure that you're getting demand even in this environment?
Are you concerned? And I know earnings are about, I think, a month away. I think you guys report on May 1st, if I have
May
my
1st.
Okay, before the market open. In terms of P&L, profit and loss, is any of this going to impact the balance sheet?
Yeah, we've actually been taking a lot of steps over the last several years to continue to position us well during periods of uncertainty. And the focus really has been, one, on gaining market share, which I think we've done quite effectively. We've gained share for the majority of our 20-year history, but during the period of disruption post-COVID, we've gained share every quarter since Q4 22, even in a category that's been down. We've taken out actually nearly $2 billion of cost, some pretty significant restructurings over the last several years. And we've improved our balance sheet significantly to the extent that we feel really good about the position that it's in now. And so I think actually much of the work that we've done over the last few years, this has been very challenging work. It's obviously tough on teams when you go through this level of restructuring, but I think it does position us well to navigate a period of uncertainty, both from a cost perspective, from a share gain perspective, a cost perspective, and from the balance sheet perspective.
I'm so glad we had an opportunity to talk with you, Kate, because I am also curious, heading into this, what have you been seeing with consumers in terms of maybe pulling back a little bit or being a little bit more discretionary in terms of their spending? Because we certainly have talked about consumer sentiment numbers, even spending numbers in terms of some pullback. What have you seen specifically?
Yeah, obviously I can't speak to the recent quarter. What we did share sort of on our last earnings call was, the consumer sentiment has been challenged over the, sort of near-term period. And where we saw consumers leaning in was where they saw, great opportunity for deals. So promotions continue to be a way that consumers want to lean in. And we use that really as a marketing tool to bring them to the site. Actually, on promotion, they end up, mostly buying products that are not on promotion. Only about 30% of the revenue during a promotional period is on discounted items.
Okay.
So what we're constantly looking for is when the consumer sort of feels like the category's out of favor or she's, pulling back, how do we get her attention? And how do we get her excited about coming to the site?
And how do you get her to pay more if demand is already low, if demand is pulling back during a time of perhaps strain? Big ticket, home purchases are big ticket purchases. And when spending falls, discretionary items get hit harder.
Yeah, that's, and again, as we said, the category has actually been compressed for several years now. So the category itself, by our estimates, is actually, at 2019 levels or below on a revenue basis. So obviously on a units basis is even lower, right? So the category's taken compression every year since 2021. So I think you're already operating from a category that's, been quite compressive as consumers have shifted dollars away. Our focus right now is how do we get that product in front of her that's exciting and appealing to her? Over time, as the housing sector improves, that obviously improves the category quite a bit because the category's been compressed because the housing sector's, been held up. That's a key factor in sort of driving that compression.
It's only 4 months in, Kate. 3 months in.
It's only three. Sorry, Carol.
Is it only 3 months?
I know.
It's only 3 months.
Can I ask you, do you feel like you have visibility to the end of the year or not yet?
Really, most of our playbook remains the same.
Okay.
Right? And so I think that's actually what's important to remember in this position is we are focused on the long term. We know that this is a period of disruption. We believe that retailers that focus on delivering for their customer, managing costs quite tightly, having a strong balance sheet will navigate through this effectively. And so our focus is on delivering that value for our consumer, however best to do that, and maintaining very tight and efficient cost controls. And that, I think, is what we've been doing over the last several years and sets us up quite nicely going forward.
Well, we so appreciate time. We know it's been a crazy day for you, a crazy year already for you, as it has for all of us. So great to get some time with you. Kate, be well. Kate Gulliver, she's Wayfair Chief Financial Officer, joining us from Boston.
This is the Bloomberg Businessweek podcast, Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.